We picked you specifically for the final trading day of this quarter, specifically so we can ask you how are the next 6 months going to look. And you laugh because I know you don't know the answer to that. But talk a little bit about the momentum in this market, which has faded a bit, at least compared to what we saw in the first 4 months of the year.
I'm still pretty bullish on stocks for the year, and I think we've got further upside. Now, of course, as is mentioned, I think there's certainly scope for volatility to pick up. Typically in election years, as you move from the second quarter to the third quarter, volatility as measured by the VIX tends to jump by about 25%. So I'd certainly be in the camp that we're going to see some choppy markets over the course of the summer. You've got the election uncertainty, and I don't think last night's debate eased anybody's concerns around election uncertainty. But that being said, when I look at sort of what's driving the market, mega cap stocks, right? They've got great balance sheets right now.
Yeah.
You think about 29%, 39% of R&D spending out of the S&P 500, 23% of free cash flow, 16% of S&P 500 capex. They're making so much money that they're now issuing, some are issuing dividends and buying back shares.
Right.
So I think this can continue.
So there is a fundamental case here to see. I mean, with some of those names that you're talking about, that you're alluding to here, these are companies that are sitting on monster gains on a year-to-date basis here. But you think the fundamentals will be supportive of those valuations? Not
just the fundamentals for mega cap, but also the fundamentals for the rest of the market. I mean, you look at where earnings growth numbers are expected to head by the fourth quarter of this year for sectors like healthcare, materials, financial, significant year-over-year gains in earnings. And we're actually expecting that broadening out in earnings growth for the rest of the market to actually provide a bit of durability in this rally through the end of the year.
Does this include small caps? And I ask because the one event we didn't talk about so far today is the Russell rebalance, and it's going to happen after the close. And the super sexy ones like super micro are going to go into the Russell 1000. So what's left for small caps?
Well, it's interesting because when you actually look at 2025 earnings growth for large cap versus small cap, you're looking at about 14%, analysts expecting about 14% earnings growth for the S&P 500, but about 17% earnings growth for the Russell 2000 small cap. So as next year earnings numbers start to get more into investors' purview, we may start to see a little bit of rebound in small cap over the back half of the year. Now, we have to caution, right? If growth starts to take a more concerning turn downward, labor markets start to roll over, that narrative is going to start to change a little bit. But I think perhaps, third, fourth quarter, we could start to see a bit of a rebound finally in small caps relative to large caps.
So does that imply then we see rate cuts, but that's a rate cut to normalization, not because they're worried about growth?
Very gradual rate cuts. That's still the base case. I think you need a more material recession. And honestly, even if a recession were to occur, it could be shallow enough where it's almost hard to call it a recession. Probably very modest moves higher in the unemployment rate. And even in that environment, you're talking about the Fed cutting rates perhaps 5 or 6 times next year. Certainly not back down to zero, I'd say.
I am curious on one point, though, too, when we talk about how supportive buybacks and overall just cash generation and return of cash to investors has been for the rally here. I know we're heading into an earnings season, so maybe that will slow down a little bit until we get through those earnings here. But do you think the companies will have not just the cash to do it, but the willingness to continue to do that, particularly given some of the CapEx needs that we've been talking about when it comes to AI, data centers, and all that kind of stuff?
Yeah, perhaps, the buyback story could take a bit of a breather somewhat. AI spending is expected to be very, very strong over the next couple of years. But also with equity markets hitting new all-time highs, companies tend to buy back shares when they think they're a little bit cheaper, relative to what the markets are pricing in. So buybacks could take a little bit and may not contribute as much to earnings per share growth over the next couple of quarters. But I think it's nominal GDP growth, which is slowing, not falling off of a cliff, and a continued focus on margins, which have started to improve over the last couple of quarters, perhaps continuing to improve over this year and into next year.
Okay, just staying with this quarter, though, because 2 weeks we start to get banks. What are earnings going to look like, and are they borrowing growth from next year at this point?
That perhaps may be the sector, actually, where buybacks here could be pretty strong. The Fed stress test just came out, and all 31 banks more or less passed with flying colors. So with this backdrop of they've already firmed up their balance sheets, put aside a lot of loan loss provisions in the fourth quarter of last year. Now they're in a good spot. Balance sheets are strong. They could start to return value back to shareholders.